morning. Welcome to First Mover, your first global look at today's action in the Bitcoin, blockchain, and digital asset space. I'm your host, Christine Lee, and joining me are my co-hosts, CoinDesk Managing Editor of Global Capital Markets, Lawrence Lewitinn, as well as Managing Director of International Content, Emily Parker. Good morning, Lawrence and Emily. How are you?
Hey, good morning. Happy Monday.
Happy Monday. We've got some exciting news. The CoinDesk DeFi Index is launching. So let's take a look at that. First of all, let's check it on Bitcoin. The CoinDesk Bitcoin price XVX index is currently trading at 30,680 and change. Bitcoin is down about 3.3% over the past 24 hours, and the CoinDesk Ether price ETX index is trading at 1810. ETH is down over 7% over the day, and the new CoinDesk DeFi Index DFX is currently trading at $417. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as a leader in crypto news, events, and data. All right, so we've got the new CoinDesk DeFi Index. We'll talk a bit more about that later. But, you know, stablecoins is on everyone's minds. And Lawrence, we used to think, you know, you were obsessive and freakishly on top of stablecoins, but it turns out you're right on the pulse of things.
But I'm also freakishly obsessed with stablecoins. So that's, you know, it just, every so often a broken clock is right twice a day, and here you go. Today is going to be an interesting day for stablecoins and for the markets in general for crypto, because Secretary of Treasury Janet Yellen is meeting with the Working Group on Financial Markets, the Office of the Comptroller of the Currency, and the FDIC, and they're going to have this like big meeting about, you know, what to do about stablecoins. Coincidentally, this story comes out. This academic study comes out, written by Gary Gorton of Yale and Jeffrey Zhang, who's an attorney for the Fed, that's likening stablecoins to this period of time back in the 1800s when you had the, you know, basically wildcat banking, if you will, everyone issuing their own dollars, right? And that was like the 1800s equivalent of stablecoins, you know, and that changed with the advent of the Fed. So it'll be interesting to see what is going to come out of this now. Are we going to have this a new regulation of stablecoins that we didn't see, and you know, likening it back to what happened 100 years ago when the Fed wanted a monopoly on currency? Who knows what's going to come out of this?
Emily, what are you watching?
Yeah, I mean, I have to, for once, agree with Lawrence here that stablecoins really are the big story. I mean, it's kind of funny because stablecoins were never that much of a big issue in the U.S. They were really hot in China because people were using Tether as an on-ramp to get into the crypto market. So stablecoins were always a big topic in China. It's only recently that they've become a topic of interest in the U.S. So it'll be very interesting to see how regulators address this issue.
$100 billion is interesting as far as I'm concerned.
We'll talk more about that later. All right, well, Grayscale, the largest cryptocurrency investment manager, is launching the Grayscale DeFi Fund, focusing on decentralized finance tokens based on the new CoinDesk DeFi Index. Grayscale and CoinDesk are both subsidiaries of Digital Currency Group. Joining us now to discuss is Michael Sonnenshein, CEO of Grayscale. Welcome to the show, Michael. So this Grayscale DeFi Fund is Grayscale's 15th investment product and its second diversified fund offering. But first off, can you explain in very simple terms what DeFi is? What is your definition of decentralized finance?
Sure. Well, it's great to be here. Thank you guys for having me back on the show. I think from our standpoint, what we're seeing now is the development of other parts of the digital asset ecosystem that are creating new protocols for new use cases. And I think DeFi is certainly no exception to that. Truly, at its core, what DeFi means is the actual meeting of traditional financial services with decentralization. So a lot of the services that users or investors, really any financial services participant may go to a bank or a brokerage or any kind of intermediary to get anything from trading to lending to borrowing, is now being looked at and developed on these decentralized networks. And the Grayscale DeFi Fund is now a way for investors to invest in these protocols through a singular investment vehicle and get exposure to many of the assets within that broadly defined DeFi space.
Good morning, Michael. How is this going to work? Are holders of DeFi tokens going to essentially lend it to you, lend it to Grayscale? Is it going to work like the GBTC? How is this fund going to work in terms of where you're sourcing your tokens and selling it to the market?
So all of the Grayscale products, including the Grayscale DeFi Fund, are solely and passively invested in the underlying digital assets that make up the fund. So in this case, the Grayscale DeFi Fund has about 10 constituents at launch. And on a quarterly basis, different assets will qualify or disqualify to be included in the DeFi Fund basket. We source all of our assets through our sister firm, Genesis, which is a registered broker-dealer. And so we are taking all of the appropriate precautions to ensure that we source the underlying tokens as investors are coming into the fund from regulated counterparties. And we know the source of funds as they invest in the product itself.
Good morning. Congratulations on the launch. Can you tell us a little bit about what you see as the unique risks facing DeFi, either on the regulatory front or elsewhere? Because the risks seem a little bit different from those that face Bitcoin.
I don't think it's as differentiated a scenario as it is from other parts of the digital asset ecosystem. I think many investors have continued to come to Grayscale really because we're providing them with an investment option that fits within their existing regulatory frameworks and allows them to access crypto in a way that feels familiar. Certainly DeFi, however, I do think is a newer part of the crypto ecosystem. And so as investors think about whether or not diversifying their crypto portfolios into DeFi is something that they want to do, they should certainly consider where DeFi is in its evolution as compared to other parts of the crypto ecosystem that have maybe been around for longer or have already gained greater adoption or traction within the investment community.
Hi, so Michael, the exposure to Uniswap, it's almost 50%. It's half the index. Does that provide? Does that make it too exposed to Uniswap? And is there a way for fund managers to? Is that something that you think is beneficial to fund managers who are, let's say, benchmarking to the index?
Well, so this is a diversified offering, and it's a market cap weighted product. And so what that will allow is that over time, as investors remain invested in the product, the fund will, because of the index construction and methodology, will continue to keep higher weights to the assets which constitute a greater part of the DeFi protocols and a lower weighting to those which are gaining either less adoption or are less valuable compared to others out there. And so while this is the fund composition and weightings today, that's not to say certainly that this will be the composition of the fund when we get to the first quarterly rebalancing at the end of Q3 or at the end of Q4, in which case, we certainly do expect DeFi as in protocol as a level to continue to morph and evolve. And certainly we'll see both new assets come into the fund, assets leave the fund, as well as see those weightings shift over time.
We've heard from members of Congress, Michael, that they are concerned about decentralized finance and the potential that it has for illicit activity, and they want to look at it more for KYC and AML. How I know you answered this with Emily, but maybe you could go over some of the risks regulatory-wise as more governments start to address and look at DeFi.
Well, I think the DeFi protocols that we're seeking to put into the fund these days are things around decentralized exchanges, lending, borrowing. And so to your point, they certainly do challenge a lot of those existing financial services offerings that investors are typically used to seeing. We believe that it's only a matter of time before we'll see increased, regulatory clarity provided around some of these assets. And I think that's true of the digital currency space overall. I think it's a space that's evolving rapidly. And so to see regulatory attention being paid to this, I think is an excellent thing. I think investors are really moving towards this idea of a sharing economy where some of these protocols can allow them to access some of those same products and services that they maybe rely on for banks today, but can instead do so in a completely distributed way. And so over time, you will see, more KYC, AML implemented in a lot of these different protocols.
Just ask a sort of larger market question. How much do you expect DeFi to correlate with Bitcoin prices going forward? Or are they completely two totally separate worlds? And also, looking at Ethereum, Ethereum has been known to sort of be the engine of DeFi. Do you think it will stay that way, or do you expect that to change? So I guess for people following DeFi, will there be correlation between Bitcoin and ETH prices?
It's really tough to predict. I think based on the user adoption that we're seeing around DeFi and DeFi protocols, we do think the future for this area of the market is bright. And again, are certainly launching this DeFi fund, certainly not only based on our own work within the ecosystem, but also in response to investor demand. And again, investors really wanting to think about diversification within their crypto portfolios. So going beyond just having exposure to either Bitcoin or Ethereum or some of the large cap coins, and also ensuring that their portfolios encompass other parts of the digital asset ecosystem. To your point, Emily, though, a lot of the DeFi protocols are built around Ethereum. Hard to say whether or not that'll continue to be the case over the long term, but certainly that has been, to your point, the fuel for a lot of the DeFi adoption we've seen.
Michael, a lot has been made about this unlocking of shares of the Grayscale Bitcoin Trust, and that there might be some downward pressure on the fund, as well as perhaps a boost in Bitcoin, as people who are borrowing money to buy shares in the Grayscale Bitcoin Trust would potentially have to buy more Bitcoin in the spot market. Would love to get your take on the whole speculation around that.
Yeah, so I think that it's important to think about just the market dynamics that are at play here. Just to level set for everybody tuning into this, the Grayscale Bitcoin Trust has historically created shares at net asset value. And after a 6-month holding period, those shares become eligible to be sold into the secondary market. And so if you look back historically, 6 months ago, 7 months ago, several folks have been thinking about and writing about a large amount of assets that were put into the fund 6-7 months ago and should now be making their way out into the public market. Now, I think what's interesting about this dynamic is that even though the product is an open-ended structure, on the secondary market, it trades more like a closed-end structure. So there is no redemption of shares. And what we've seen now at the moment is, probably about a 10% or so discount to the net asset value within GBTC. And so it's difficult to predict exactly what the effect will be of some of these unlockings, whether investors will, sell those shares right away, or these continue to be Grayscale investors that typically have longer term horizons for their investment in Bitcoin. However, I would share that we have started to see quite a bit of institutional capital and smart money moving into the product and looking to deploy assets into GBTC at a discount to NAV, because it does allow them to own or control more Bitcoin than if they were to take that capital and buy Bitcoin in the spot market.
So, Michael, does the composition of your counterparties, does that change? For instance, we're seeing some people potentially getting hurt because the premium went to a discount. For instance, was BlockFi affected, for instance, by this change from premium to discount? We noticed that they're providing lower rates relative to the market to their customers, and the speculation is wondering is whether or not companies like that were affected somehow because of the change from premium to discount. Does your counterparty composition change?
Well, investors who buy the private placement and then get that liquidity after 6 months have that optionality to sell those shares out into the public market anytime after that 6-month period. We don't have direct visibility of when investors sell their shares because they're moved back to their brokerage accounts or their prime brokerage relationships, in which case they have complete discretion as to whether or not they remain invested in the shares or sell out of them. So it'd be difficult to opine on specific customers or clients.
Okay. Michael, appreciate you coming onto the show, and congratulations on the new fund.
Thank you. Great to see you guys.
Right, that was Grayscale CEO Michael Sonnenshein. Coming up, checking in on Asia and a crypto markets update with EQIFI.
CoinDesk Indexes, the market standard for crypto assets since 2014. Our trusted data powers billions in publicly traded funds. CoinDesk Indexes are the standard used by institutions, and they're the key for investors looking to understand and access crypto markets.
As the company that launched the world's first ever Bitcoin ETF, we at Purpose chose the CoinDesk Bitcoin Price Index, the XBX, to price our assets.
CoinDesk Indexes enabled the early adopters to build crypto investment vehicles, and they're already trusted by a new generation of global investors.
Time now for the daily forecast, an update on what's happening in the Asia crypto markets. Here's Angie Lau of Forecast News.
Welcome to the Daily Forecast, July 19th, 2021. I'm Angie Lau, Editor-in-Chief of Forecast News, covering all things blockchain. Coming up, China releases its ECNY white paper. Bitcoin mining difficulty falls for a fourth time in a row. And Malaysian police steamroll seized crypto mining rigs. Literally. Let's get you up to speed. From Asia to the world. China has released a white paper on the development of its ECNY. The paper explains how the People's Bank of China plans to launch its digital currency and how it's progressing, as well as explaining how it will work in parallel with its physical RMB. One key detail here, the PBOC confirms it is developing the smart contract feature of the ECNY to make it, quote, programmable, more expandable, and better integrated into various scenarios. It also says that while the digital currency is technically ready for cross-border use, internationalization of the RMB is not the goal of the project. Trials designed to test the stability and user-friendliness of the ECNY have already taken place in 10 cities around the country. The PBOC says that those trials saw nearly 21 million personal wallets opened and transactions worth a total value of around 34.5 billion RMB. Get that, it's about 5.3 billion US dollars that have taken place so far. It gives no date for an official launch as yet, but many experts have predicted that wider operation of the ECNY will begin in time for the 2022 Beijing Winter Olympics. Meanwhile, Bitcoin mining difficulty has fallen for a fourth consecutive time. According to data from BTC.com, the difficulty level fell almost 5% on Saturday from the previous calculation, and it's now 45% lower than it was when it hit a high for the year on May 13th. That's the longest slide in history. The difficulty level is calculated every 2016 blocks, which works out at roughly once every 2 weeks. It refers to how hard it is for a miner to dig for Bitcoin. That difficulty depends on the global hash rate, which indicates both demand and miners. Now, recent falls have been blamed on the clampdown in China, which has forced many of these miners to move overseas. Despite this, data from the University of Cambridge Center for Alternative Finance says the country still accounts for 46% of Bitcoin's total hash rate. So how is Bitcoin doing today? Well, it's down nearly 0.25% at just over $31,500 US dollars. And that's as of 4 p.m. Hong Kong time at the end of the Asian trading day. And in the top 10 for cryptocurrencies, Dogecoin and Ethereum both down around 3%. In Malaysia, police have destroyed over 1,000 Bitcoin mining rigs seized in raids earlier this year. Video posted by local news outlet Dayak Daily showed how police decided to put on a little bit of a show by using a steamroller to crush the machines. More than 1,000 machines were crushed, reportedly worth 5.3 million Malaysian ringgit, or around 1.3 million US dollars. The raids, which took place between February and April this year, saw up to 8 suspects arrested, 6 of whom were charged with stealing electricity to carry out crypto mining operations. They've now been jailed for 8 months and were fined up to 8,000 Malaysian ringgit, or almost 2,000 US dollars. And finally today, Chinese online shopping giant platform Taobao, has included NFT sales in its annual Maker Festival, which celebrates innovation and creativity from Chinese artists and entrepreneurs. Near Protocol, which Alibaba-owned Taobao has partnered with for the sale, says this is the first time the event will be selling NFTs. The works are by Huang Heshan, which creates designs of quirky residential buildings which are being sold as NFT real estate. The artworks are only available to buy via Taobao using renminbi. Purchasers will then have to register a wallet with the Near Protocol to be able to claim their digital artwork. It's not the first time an Alibaba affiliate has explored selling NFTs. Payment app Alipay sold 32,000 pieces of NFT art in June. And that's the daily forecast from our vantage point right here in Asia. For more, visit forecast.news. I'm Editor-in-Chief Angie Lau. Until next time.
The Crypto Markets Update is presented by Grayscale, the world's largest digital currency asset manager. Time for a live look at Bitcoin. The CoinDesk Bitcoin price XVX index currently trading at $30,768. Bitcoin is down about 3% over the past 24 hours, and the CoinDesk Ether price ETX index is at 1824. ETH is down almost 7% over the past 24 hours. And the new CoinDesk DeFi Index, DFX, is currently trading at 415. The DeFi Index is down a little over 8% over the day. All right. Meanwhile, total locked value in decentralized finance clocks in at over $55 billion, according to DeFi Pulse. Joining us now to discuss the crypto markets is Brad Yasar, CEO of EQIFI, and a DeFi lending, borrowing, and investment platform for ETH, stablecoins, wrapped Bitcoin, and more. Welcome to the show, Brad. So you're looking at DeFi. How is that comparing to the rest of the crypto markets right now?
Well, I think DeFi projects are moving in the same direction as the general market trends, but with the advantage that the projects that actually bring real value to the ecosystem are less speculative and are seeing less of volatility.
Any projects that you're particularly interested in watching right now?
Well, I mean, I'm very excited about EQIFI and our upcoming launch. But aside from that, there are a couple projects that are working on bringing insurance into the DeFi space, and I think that's gonna be a game changer, because it's very exciting to hear the word insurance in decentralized finance, where a lot of the times, traditional financial people couldn't see the two coming together. And there is some really good work being done to bring some stability into decentralized finance products.
At the same time, stablecoins are in the news a lot these days, and El Salvador may even issue its own stablecoin, the colon dollar. I wonder how is that going to operate with the rest of the markets in your opinion?
Well, a successful central bank stablecoin has not been done yet, so I don't know how that's gonna really connect with the rest of the financial world. The challenge right now is stablecoins are widely used and adopted in the cryptocurrency space, but they're not widely accepted by the rest of the crypto community, which is something we're working really hard on bridging with EQIFI. So what I'd love to see is more acceptance of their stablecoin if and when it's successfully launched in the global banking systems. I mean, that would be a game changer if they can accomplish that. Issue a central bank stable currency, get it adopted within the country, and then have international counterparties that also accept it.
So putting aside the acceptance question for a moment, I mean, recently one of the hot topics in crypto has been the risks of stablecoins, right? Stablecoins have traditionally kind of been one of the more boring aspects of the crypto industry, and now everybody's talking about the risks. What do you see as the main risks of stablecoins? Like, what is the worst that can hear? What are some of the worst case scenarios? If you could just break that down for us.
I think the biggest risk I see is loss of faith in stablecoins. because I mean, a stable coin is, for me, stabilized by another asset or something that brings that value lock in. And so far, even the biggest, most widely used stablecoin, Tether, has had a lot of challenges and a lot of problems explaining and being audited for the peg that they're maintaining every time they issue more Tether. I think that's the biggest risk. If the future stablecoins, either programmatic or asset-backed, can't find a way to convince the general public that they are what they are. If it's a dollar peg stablecoin, it has to have a dollar peg and the assets to or the mechanisms to provide that peg. If it's a euro-based stablecoin, it has to be euros. I think the biggest challenge the stable coins, that industry as a whole faces, is proving to the users that it is truly stable and there is a mechanism and the assets needed to provide that value. Otherwise, it's just going to be a rush to the banks with stable coins, and that's going to be very difficult to watch.
So,
Sorry,
Brad,
what does the rush to the banks mean? I just want to understand, other than the loss of faith, like what is kind of the consequence of that? Because I think it's important for people to understand, like, what actually could happen. When you say a rush to the banks, what do you mean exactly?
Well, I mean, if you look at the traditional banking system, if they have a rush to the banks, they only hold a certain amount of the value that they have under their in their accounts available. So if that's depleted, then people are unable to withdraw their money. The same logic would apply to a stable currency. If everyone loses faith, and let's say Tether disclosed that it had 70% in liquid but non-fiat investments backing the asset, how fast can Tether get out of those 70% non-fiat assets to pay back the US dollars that people would want in exchange for their Tethers? That would be a big challenge for that cryptocurrency. If we want to talk about El Salvador again, if they say our asset, our digital bank cryptocurrency is backed by this asset, whatever it is, and they can instill the confidence in the user base that that is true, people can go and redeem that digital currency to a point where it collapses because you can't liquidate fast enough all your portfolio if everyone is trying to get out of your asset at once.
So, Brad, we have Janet Yellen having this meeting today regarding stablecoins. What do you think will come out of it? And ultimately, what will it mean, particularly for DeFi? We've been talking about the effects of stablecoins, but what would happen in DeFi itself, and what would happen in Bitcoin and ETH, for instance, and some of the other major traded cryptocurrencies, if there's a regulation in stablecoins, if it's potentially onerous? Who wins? Who loses? What happens?
That's a really good question, and it has multiple parts. So I think, obviously, with EQIFI, we're fully licensed and regulated. So we support regulation, sensible regulation that gives us the guidelines to build new things and try new things and instill confidence in our ecosystem that we're going to be responsible with the value that's trusted to us. So in a way, I welcome the meeting. The fear I have is a lot of the times these meetings don't have all the parties that should be a part of the conversation. A lot of these very high-level meetings don't have the right tech-savvy technological understanding and know-how to address the issue in a sensible way. And unfortunately, a lot of the times the parties to these meetings are old school bankers who have the most to lose from any kind of innovation. So you combine the two, usually it turns into some effort that really doesn't land the way it should. when we're talking about regulation, and regulation helping innovation, not hindering it. If some heavy-handed, overreaching argument comes out of it, of course, that's going to have a negative impact on crypto markets, DeFi included, Bitcoin included. I mean, DeFi projects are tied to Bitcoin and vice versa. It's one of the assets that, with Ethereum, that fuel the whole activity. So my concern would be that if some announcement, even if it doesn't become law, is pushed out and rushed to show force, certain parts of the world, United States to begin with, since we used that example, are going to be left behind, because innovation is just going to leave those countries and go to maybe smaller countries with regulators that are more open to a dialogue. I mean, everyone wants to know where the lines are drawn, but if they're drawn too tight, then you don't have any innovation. You just keep doing the same thing. And obviously, DeFi is not doing the same thing.
Very fascinating. We'll be watching those developments as they happen. Thank you so much, Brad, for joining us.
Thank you for having me.
That was EQIFI CEO Brad Yasar. Coming up, we'll talk about blockchain unicorns, and China's getting some side-eye from the Biden administration. More on that with CoinDesk Global Policy and Regulation Managing Editor Nick Day.
When we say we want to reimagine money, it turns out we're going to the heart of the matter. Imagination has always been a key part of what money is. Imagination, in the form of cultural creativity, is also something that the cryptocurrency community has in spades. And to the outsider, that can be a reason to dismiss it as frivolous, as something built on nothing. To dismiss it for these reasons, though, is to ignore that all money is imagined.
Welcome back. Let's check in with CoinDesk Global Policy and Regulation Managing Editor Nick Day, who is also the editor of CoinDesk's The State of Crypto newsletter. Hello there, Nick. So you're writing up a new piece about the Biden administration. They're accusing Chinese state actors of conducting ransomware and cryptojacking attacks. What's going on?
Yeah, so this morning the Biden administration announced that it's filing charges against 4 hackers that it claims are supported by the Chinese Ministry of State Security, who allegedly, conducted a number of different cyber attacks, including, ransomware, extortion, cryptojacking, and the administration further said that this is part of a broader effort by the Chinese government to, basically use these attacks for financial gain. So, you have the individual charges, but also, a huge sweeping statement that attributes a number of different activities to the Chinese government, including the Microsoft Exchange hack from earlier this year.
And Nick, we've gone about 5 minutes without saying the word stablecoins. But as you know, Janet Yellen is going to have this meeting that we talked about at the top of the show. With some of the regulatory bodies, including the FDIC, which was interesting, their inclusion to discuss stablecoins and the future of stablecoins. What do we expect coming out of this, really? And the timing of that report that came out this weekend, was it coincidental, or do you think there was more to it?
So tackling the second one first, it seems pretty clear that they, authors of that report, it's a Fed official and a Yale professor. They seem to have, either pushed it up or definitely tried to just get it out ahead of this meeting. The first footnote in the report actually referenced that this meeting, which was publicly announced on Friday, it was happening. So, clearly some finagling had to have happened there. And as for what to expect, the I think key line for me was they announced that there would be written recommendations coming, and unclear what that means and when specifically. But the last time the president's working group on financial markets met, we saw a list, a statement, advocating for different approaches to crypto and stablecoins, and it kind of feels like what we might expect is either an escalation or at least, a further reiteration of this focus on, finding ways of regulating it such that retail investors are not exposed to risk, that the financial markets are not exposed to risk.
Yeah, do you think this is part of getting the taxonomy bill passed through Congress? In other words, nudging it along a little bit more, which we've talked to even Republican members of Congress that want to get it passed. Do you think that there'll be some sort of synergistic ecosystems here, if you will, combining the two opinions of the White House and Congress to get this going?
So it kind of feels more likely that we'll see some rulemaking from the regulatory agencies rather than, an effort to go through Congress, just because it doesn't seem like Congress is going to, it's not moving very quickly on anything beyond, at this point, just, study bills saying like, okay, let's ask these agencies to take a look and provide recommendations on how to regulate this space. So, if we're looking at Congress's efforts, it's going to be a long while before we get anything concrete in the form of actual regulation or bright lines regulation. So rulemaking seems a little bit more likely to me at this point.
Can you break down what stablecoin regulation could look like? Like, what would that entail exactly?
Yeah, so there are a couple different schools of thought. Some individuals or some advocates for regulation claim that treating stablecoin issuers like a bank might be the best place to start, because stablecoin issuers take customer deposits, they issue out their own bearer asset basically, and they conduct a lot of the same services that you might expect a bank to. You have some individuals who think that maybe a better place to start is securities law, because some stablecoins are backed by a basket of assets, just like certain types of securities. There's a lot of different theories as to how you could regulate stablecoins, but a lot of the key issues that they're looking to mitigate are either consumer risk or financial market risk, economic stability. Basically making sure that you don't have a giant billions of dollars worth of an asset floating around that are either unbacked or people put their money in, can't get them out. So those are some of the concerns that regulators have brought up repeatedly over the last couple of months.
All right, Nick, thanks for the update. Looking forward to when you monitor the Yellen meeting later today.
Thank you.
That was CoinDesk Managing Editor of Global Policy and Regulation, Nick Day. Don't forget to sign up for the State of Crypto newsletter on CoinDesk.com.
The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
So our next guest predicts there will be more than 10 new blockchain unicorns that will emerge this year as governments move forward with central bank digital currencies. Joining us now is Matthew Merle, managing partner of Fifth Era and of blockchain co-investors of Blockchain Venture Fund of Funds. Welcome to the show, Matthew. So what part of the crypto industry do you see a stampede of unicorns emerging from?
Well, it's great. Thank you very much. It's great to be here, Christine. And so the answer to that is everywhere. We think of this as a technology stack. And down at the foundational layer, we tend to see most of the projects choosing to be crypto projects. And their value capture is in the value of their tokens. At the transactional layer and the application layer of this technology, we tend to see blockchain enterprises getting backed with equity. And we're seeing the rise of a large number of unicorns on the blockchain enterprise side as well. So it's happening on both sides, crypto projects and blockchain unicorns.
So Matthew, to quote a medieval knight, which unicorn should we hunt? I mean, basically, which one do you think will provide the best returns? Where should investors throw their money?
Well, it depends whether you want to be an early stage or a late stage investor. We're primarily early stage investors. We're investors in about 300 blockchain unicorns and projects, so of all sizes, but we invest early. And I should just, for full disclosure, say we're also investors in DCG. So for us, we need to be highly diversified. And in order to be highly diversified in an emerging technology like this, you've really got to cast a broad net. And so we invest on both sides. We look for all of the emerging themes, whether it be DeFi or the rise of digital wallets, digital exchanges, settlement systems, the underlying protocols, the applications, and so on. Any names? Sure. So in the last year, We've seen the rise of a bunch of blockchain enterprise unicorns. The NFT space has given rise to Dapper Labs, Animoca, Forte, all of whom are now rising up in their value chains, driven by great interest globally in digital assets. We continue to see the rise of digital wallets. We saw, obviously, Coinbase go public, but we know that there's going to be room for a lot of wallets and exchanges. We have about 10,000 banks in the world. Most of those banks do not have a digital wallet. All of those banks will need a digital wallet. And so obviously anyone who's building a fully capable wallet today, it can be the Mercados in Latin America, it can be the Bitpandas or the Bitthumbs in other parts of the world. These digital wallets are raising in value very quickly because you can't have a digital world without digital monies, and digital monies requires digital wallets. And so the people that build digital wallets are going to be in demand, and their infrastructure is going to be used much more in the future. Whereas obviously if you're a traditional bricks and mortar bank, most of your infrastructure is legacy and most of it's going to get stranded. And that huge shift is what we see reflected in the value capture in this space.
So you're clearly bullish on a lot of blockchain projects, but could you just maybe, while we're naming names, are there some investments that investors should stay away from, like blockchain projects that are not going to become unicorns and people should be wary of putting their money into?
It's a great question, and the answer is most of the projects will fail. In early stage technology, that's always true. In the past, I helped run the world's largest angel group. We back 300 or 400 companies every year. That's called Keiretsu Forum. And we learn every day that early stage technology is a risky space to invest, and most of the projects will fail. For the world's largest venture capitalists, about 60 to 70% of their projects will fail. And I see no reason to believe that blockchain and distributed ledger technology is any different. The failure rate is extremely high. And if you're going to be an investor, you need to be broadly diversified. And that's what we do. We're an investor in 25 blockchain VCs globally, Europe, North America, and Asia. And we make sure we have very broad diversification. I think indexes and ETFs can help, but they're only just arriving on the scene. And I know you have a family of those products under the DCG umbrella, so does Bitwise and others. But diversification is key in marketplaces with high risk and high volatility.
Matthew, you've got to wrap it there, but thanks for joining us on the show. It's a risky business, so thank you very much. All right, that was Matthew Merle, managing partner of Fifth Era and of Blockchain Co-Investors. Time now to check in with Crypto Twitter with our tweet of the day. We've got one coming in from Dan Held, who's the Kraken growth lead, saying, in 2001, we adopted the dollar for the benefit of the banks. Today, we are adopting Bitcoin for the benefit of the people. And he's attributing that as a quote from the president of El Salvador, Nayib Bukele. But the follow-up tweet to that, and we can't bring it up right now, but it's from Kyle Gibson from MIT saying, looking forward to watching the powerful logic on display as Bitcoin maxis that praised Bukele for choosing Bitcoin as El Salvador's only state crypto all tried to feign support for the dictator's new fiat-backed currency. A couple people out there raising eyebrows over a stablecoin. Yeah. All right, that's it for First Mover. Thank you, Emily Parker and Lawrence Lewitinn. I'm your host, Christy Lee. I'll be back live at 3 p.m. with all about Bitcoin. Coming up at noon is The Hash. You're watching CoinDesk TV.